All right, welcome back. For the last 4 lectures, I focused on market efficiency and price. I consider those essentially related topics. Market efficiency really relates to price and value. Market's efficient, price equals value. Very tough to get an edge, hard to create alpha, hard to charge for active management fees. So you'll hear me talk about price and market efficiency kind of in the same vein. Today, what I want to do is shift now to the other side of the equation. The equation I set up for this series was price versus value, or P versus V. And today I'm going to start my lectures on valuation. There'll be a series of lectures that follow. But today's topic is, why do we discount cash flows, future cash flows? All right, so as we set this up with a simple chart, simple diagram where I said price is less than value. Obviously, there's lots of other conditions that go into it, but this is kind of a simple construct, a simple way to think about price versus value. The last couple of lectures, I focused on price. Today, we're going to focus on value. And we're really going to start at the very beginning of valuation. So for some of you, this is going to be a complete repeat. For others, maybe you'll find some insights in my comments. All right, so the valuation components, the components that drive valuation of any asset, and a stock is an asset, obviously, or the first level are cash flows. That's the definition of fundamental value. Uncertainty of those future cash flows, and then the time value of money. And what I want to focus on today is the time value of money. The sub 4 components of cash flow are the timing of the cash flow, the duration or how long those cash flows will last, the magnitude of those cash flows, how big are they, and then is there any growth to those cash flows? Now, what's interesting is when you start to think about valuation of stocks, not just of an asset, we assume away any timing concerns because the convention is almost always to look at annual cash flows. So we can kind of assume that away, get rid of one of the variables. We're not going to look at inter-period cash flows or intermittent cash flows. We're really going to think about annual cash flows. So if we're going to do valuation, we've got to talk about the duration, magnitude, and growth of those cash flows, which I will get to over the next couple of lectures. What I really want to focus on today primarily is the notion of the uncertainty of those cash flows, how you're going to think about that, and then the time value of money. All right, I will argue throughout all my lectures that the fundamental value of any asset is effectively a DCF, discounted cash flow model, which we see often depicted as the equation on the right. What it means is the summation of all cash flows from now until forever, discounted back. Now, what's interesting is that when it's generally taught in business schools and textbooks, in prep courses and things like that, almost everybody says we discount back for time, true, and risk. And it's not. It's time and uncertainty. In, probably at the pace we're going, it will be a couple months away. I'll come back and really define the difference between risk and uncertainty. It's a distinction that's important and often missed, but that's for a future lecture. All right, so the fundamental value of any asset is the present value of all future free cash flows discounted back for time and uncertainty. So we're going to talk about that. So in the equation, FCF is your free cash flow, R is your discount rate, and T is the duration of payments. What I'm going to focus on today is the discount rate. I will focus on my next lecture on how we want to define what free cash flow is, what are the cash flows we're discounting, and then the lecture right after that, I'll talk about how you think about the long-term nature of the cash flows. All right, so the discount rate. The question I like to ask is, why discount? Why do we discount? And when I do this in class, in my course, it's always a fun, lively debate, and I'm kind of fascinated by the answers. And what I've learned and quickly established in the classroom is that most people have a vague idea of why we discount, or at least some sense of why we discount. But almost nobody can articulate it crisply why we discount. And so that's why I keep this segment in my courses, and that's why I'm making this video. All right, the first answer I hear most often is the time value of money. Why do we discount? Because of the time value of money. I follow that up very quickly with what is the definition of the time value of money. And you get into almost always we get into a circular debate that money in the future is worth less today than money today. And then you push on that, and you push on that, and you push on that. And it gets squishy pretty quickly. So rather than have a debate, hard to do in a video, although if you want to pause and write down your answer, see how you did, you can always do that. All right, so the first thing we talk about and why we discount is the opportunity cost of money. Now, what's often missed in the discussion is there are two opportunity costs. One is, I think, the most obvious, but almost never gets answered. You can consume the money today. You can spend it today. And spending money today will create some sort of utility, some sort of benefit, some sort of potential enjoyment. So money has value today because you can spend it, you can consume it, or maybe you have an obligation you have to pay. So that's why it has value. To not consume today, not use the money, is where it gets interesting, and that's where we start to unpack the idea of time value of money. Because if I'm not going to consume it today, I'm going to effectively forego that, maybe consume it in the future. I need to be incentivized to do that. Now, the first layer of that opportunity cost is I can always invest that money. So if a new investment opportunity comes along, it is inherently competing with two possibilities. I can consume the money today. So the investment better give me a better future return, a better return than my current consumption. Now, maybe you're satisfied all your needs and this money is effectively savings or investment money. So the current consumption's been satisfied. The second hurdle you have to overcome in any new investment is the alternative investments, because I can invest in this new opportunity, the new stock that I have found, or I can invest my money in something else. And there's just a plethora of options, everything from what we call in the U.S. risk-free. You can do government bonds, but you have other credit instruments. You have other stocks, you have ETFs, you have indexes, you have real estate. You go venture capital if you have access to that, private equity if you have access to that. So the opportunities for your investment is really not endless, but certainly very extensive list. So I have to, any new investment, any new set of future cash flows has to compete with either current consumption, which may be easy to overcome, and then all of the alternatives. So that's sort of the key. Now, I'm going to use in all of my valuation lectures the long-term government bond, and in this case, I'm going to use the 30-year bond. When we get in deeper into valuation, and particularly in growth, I'll come back and explain why I like the 30-year bond. Some people in equities use the 10-year bond. All are good, but that gives you a risk-free alternative to invest your money. So any new investment's got to beat that, particularly if there is uncertainty related to it. All right. Now, here is your implied 30-year real rate over the last, what do I have here? I guess it's 5 years, just to show you a short chart. We'll show some longer-term charts in a minute. And you can see that the implied real rate now, this is probably a month old now, is about 2.25. That's the implied real rate. Interesting, if you look at this chart, when we went into the big money printing era in 2020 and 2021, the implied real rate was actually negative. Because there was an implied inflation. We'll talk about inflation in a moment. But the implied real rate was negative, which is somewhat unheard of in history. And when you saw big valuations in 2020, and we'll talk about that in the next couple of lectures, what you saw, that part of that was really driven by those rates being unprecedentedly low, something we've never really seen in history. All right, so the first takeaway is that the implied real rate, 30-year real rate, is about 2.25. It's been as high as 2.5%, as low as negative, below zero, over the last 5 years. All right, so for the moment, when we think about it, our first layer, our risk-free layer to our discounting would be about 2.25%, just for purposes. Now, the 30 over the last 5 years, that's been somewhere between 0 and 2.5%. We're very close to the high of that. So using 2.25 is probably not a bad place to start. All right. So the current long-term 30-year government bond real is about 2.25. The 10-year range is about 0 to 2.5. And I'm adding in the range because when you start to think about what discount rate you want to use, it's probably better to think a bit of a range rather than a point number. All right. So we're going to use sort of 0 to 2.5. That's your 10-year range. All right. The second reason that we need to discount is because almost always, not always, but almost always, currency goes through an inflationary period. Now, I could spend a pretty long video on inflation since most people I meet have no idea what inflation is, where it comes from. Macroeconomists continue to teach nonsense around inflation is driven by money supply. That's certainly not the case in the U.S., and I don't think it really holds up in the modern global economy. That's another lecture, another day. All right. But we do know that over time, the purchasing power of currency always goes down. The effect is the prices go up. So it's the purchasing power that goes down. That's the key to the inflation. Prices are just a residual of that. So if I'm going to forego consumption, I'm going to make an investment, I want to be able to buy the same number of Happy Meals in the future that I can buy today. So I need real purchasing power. And I think that's really the key. So you need to be paid back in real value, real purchasing power. And you need to be compensated for inflation. So that's our second layer of this interest rate stack, what we'll call the interest rate stack, that we need to be compensated for. The first one was just opportunity costs. I could invest in a government bond, relatively risk-free, at least in the U.S., and then number two is I want to be paid back in real dollars. So my second layer is inflation, is to compensate for inflation. All right, here's 25-year history of inflation in the U.S. as published by Federal Reserve. What's interesting, you can see that in that 25-year period, it's basically ranged between 0 and 4% until fairly recently. We had a spike in the 08 period, lots going on there. And then post that, we actually had some deflation, partially driven by housing prices. So a 25-year range of 0 to 4% seems, I don't know, like a pretty good range to have. All right. Now, big question is this temporary? Going back to the lecture, the discussion of inflation, a lecture I could probably put together at some point. I argued all the way through that it was temporary, not temporary in the sense of social media temporary, 5 seconds, but temporary in economic sense. And I really felt strongly that this was driven by the supply shocks of COVID. Now, those of you that feel differently about inflation have stopped watching my video because you just disagree with me. Well, we'll see. Time will tell. Inflation's come back down to that 0 to 4% range. And I would bet it's probably going to stay there. All right. Now, this was your annual inflation over the last 5 years. It did spike, I think, because of supply shocks. And then, I'm sorry, one more thing. It did get all the way up to 8% as a headline number of inflation. What's interesting is if you go look at the credit markets and you tease out the implied inflation in credit instruments, which are very sensitive to inflation, and never got above 2.5%. So the nominal got all the way up to 8.5 or 9, whatever it peaked out at, or what looks like it peaked out at. But in the credit markets, the implied inflation never went above 2.5%. You could argue, I think pretty well, that the credit markets believed that was temporary. And so far, they've been right. I think the way you want to think about inflation, it's come back down to 4%. Rather than think about it really now declining, I think it's more like this. It's down to below 4, and it's probably going to stay here for a little while. There's a lot of arguments that you do want inflation of about 2%. Because it's better for the economy at 2%. I'll save the full explanation of that for my inflation lecture. All right. So we've done the opportunity cost. That's a range of 0 to 2.5%. Inflation, I don't know, for the moment, we use 1 to 4%, historically in the 25 years, at least what we've seen so far. All right. So those are my first two layers. And what we can, if you look at the 30-year Treasury, which is a combination, this is nominal. So now this is a combination of the real rate plus inflation. This is where you can tease out that the current implied inflation is about 2.34%. The current 30 year is about 2.25%. So we're getting a 30-year treasury of about 4.62. You can see that it got down to below 2 back in early 2020. That's when the implied real rate went negative. You still had some inflation priced in. All right, so the implied inflation right now is about 2.34%. That's if you go look at the credit markets against a 25-year historical of 1 to 4%. So we're sort of right in the middle of that. All right, 30-year treasury is right now 4.62%. That's your opportunity cost plus inflation, and that's consistent with history. All right, so we got that. This is kind of a cool chart that I saw fairly recently, stole it and put it into my presentation. It's originally done by Homer and Sela. I got to know Dick Sela recently. He is a emeritus professor at NYU, and he's been teaching at Fordham Gabelli School for the last couple of years. Lovely guy, just a font of historical knowledge. Pretty great. Now, when I look at this, I see that the nominal rate is somewhere between 3 and 4% over the last 3,000 years, although I will say there's a lot of volatility. So I'm not sure the long-term chart gives you anything, but it's kind of fun to look at. All right, now the last layer is the risk premium. I don't love the name of this. It's really an uncertainty premium, but I'll go with the risk premium. This is, you need to be compensated for the uncertainty of future cash flows because we're dealing with equities. We don't know what those cash flows are. There's a fair amount of uncertainty related to them. So our third layer, opportunity cost is layer 1, inflation is layer 2. Third layer is risk premium. And it's about 5% historically. Now, this is the work that's done by Aswath Damodaran at NYU. He's done a fantastic job of looking at risk premium over time. I just went back, got his data, and plotted it. The 10-year average is about 4.83%. 25-year average is about 4.76%. And the 60-year average is 5.24%, according to his data. Look, he's done more work on this than I have, so I'm going to defer to him. So I eyeball that and just say 5%, risk premium of about 5%. Now, if you could reduce future uncertainty, would you accept a lower return? And the answer is, of course. We do this in bonds all the time because in bonds, you don't really have uncertainty of cash flows. You certainly have default, but generally, because the cash flows are contractual, we have a high degree of confidence in them. So if you could reduce the uncertainty of future cash flows, you would accept a lower return. I think that's important. And we know from bonds, the credit market, that that's true. All right. Now, should some investments require a higher risk premium? And the answer is, of course, and we see that in venture capital, where the uncertainty is incredibly high, and therefore they want a higher discount rate. Some venture capitalists use something like 25%. There's still, by the way, it's still 0 to 2.5 for the real rate. It's still 1 to 4 for inflation. The difference is the risk premium being compensated for the uncertainty of those future cash flows. All right, so that's my interest rate stack. Opportunity cost right now is the real rate is about 0 to 2.5. Inflation is about 1 to 4. I think that's reasonable. The risk premium about 5%. And if we add that all together, we get a full discount rate for the S&P 500 of about, right now, just shy of 10%, which interestingly is the long-term discount rate of the S&P. So we're sort of, you could argue, we're back to normal. Back in early 2020, the 30-year bond got down to 1.46 with the risk premium at the time. We had a discount rate in the S&P 500 of about just over 6%. When you go look at valuations, the S&P back at that time, realize you're using a 6% discount rate. Now we're up from 6, a little bit over 6, a little bit under 10. That's a big move. And we've seen that in the market. Although when I start talking about S&P valuations in a couple of lectures, you'll see the valuations back to where it was in 2020. Very interesting, with a much higher discount rate. All right. So just to put it back together, the risk-free return is about 0 to 2.5. Purchasing power is about 1 to 4, and uncertainty is about 5. And if you eyeball that, you get an average of 8 to 10%. Historically, the S&P 500 is somewhere between 9.5%. So again, we're back to sort of where we are by a historical norm, which means that the discount rate is kind of where it should be, probably. Higher than what we saw in the heydays of a couple of years ago. But on a longer term historical perspective, it is much closer to what we've seen, and probably is a more normalized level, one you probably can count on for the next couple of years. Now, when I do more valuation work, you'll see that I just use 10% for 2 simple reasons. One, it's about where the level is, and 2, it just makes the math easier. And when I get into it, I'll talk a bit more kind of the, if you will, the compromise you're doing. But you'll see when I do valuation work on companies in the S&P, we're going to be around 10%, which is great because it makes the math really, really easy, which is really cool. All right. And then, of course, you can adjust the risk premium higher if you like. And once you have more information about the uncertainty in the investment. But I'm going to start with 10, and then we can add to it if we want. You can also lower it if you get more information. All right, so I hope this is helpful in your thinking about it. So why do we discount? Well, we have an opportunity cost. We can consume the money right now, and maybe we have to, maybe we want to. Once we get over that hurdle, and maybe we're talking about capital that is more for investment, you're not going to consume it. Now you have an opportunity cost, direct one where you could invest in a risk-free, what we call risk-free government bonds in the U.S. Second is you need to be compensated for inflation, the decline in purchasing power. You want to be able to buy the same number of Happy Meals in the future as you buy today. I think that's important. And then you do need to be compensated for the uncertainty of the cash flows. And I'm going to lean on some pretty terrific work by Aswat Damodaran that says that should be about 5%. And we add that all together. So why do we discount? Those are the 3 primary drivers. So I'm hoping that is helpful. Thank you for watching another video. Always appreciate the feedback. Thanks.